Good afternoon, everyone, and welcome to another edition of Unlock the Stock. We really are pleased today to welcome back Tharisa. And as you know by now, this is a platform that is specifically designed for retail investors so that they can gain access to management and to get to know the company and that management team just a little bit better. Favos Parolis, the CEO, and Ilya Graulich, the Head of Investor Relations and Communications, join us today, and Favos will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website at lumiglobal.com to learn more about Lumi's various online AGM and investor presentation solutions. Our host today, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they'll facilitate the Q&A session at the end of the presentation. But before we start, there are just a few housekeeping notes. Tharisa will take you through a presentation which will be followed by a Q&A. You can post your questions by typing them into the Q&A chat box at the bottom of the screen, and these will be read out by Mark and the Finance Ghost. The event is being recorded and will be available on the Unlock the Stock YouTube channel next week. You will see an email address as soon as we go into the Q&A session, and if you would like to be added to Tharisa's contact database, please just jot down that email address. So I'm ready for you to share your screen and to take us through the presentation, which we really are looking forward to.
Great. Thank you, Vanessa, and good afternoon, everyone, and welcome to this presentation. Just confirming that you can all see the presentation and you can all hear me.
Perfect. We can hear you loud and clear, so over to you.
Okay, fantastic. Yeah, so welcome everyone, and it's a great privilege to be able to share our Tharisa story with you today. So there's been a lot of debate and a lot of, I suppose, negativity around mining, and we just want to set the scene before we get into our business and what we do. So when we look at it contextually, if it's not mined, it's grown. And this is something that maybe the younger generations don't necessarily appreciate. So in order for us to achieve our decarbonisation strategy, we need these critical metals which enable the technologies that have been laid out in all different guises, shapes and forms. And where we stand today is mining is a necessity. The way in which we do it is the differentiator. And I think being a sustainable, responsible miner is critical to being able to provide these metals. So why now? When we look at the future demands of these metals to meet these global initiatives and targets for a decarbonized planet, we see that metal demand will double by 2060. If you consider that it takes approximately 12 to 14 years to develop a mine, from discovery to production, there are long lead times and they are very capital intensive. And what we've seen over the last decade and even beyond that is a lack of investment in not only existing infrastructure, stay in business capital, expansion capital of existing mines, but there's been a substantial underinvestment in new projects and new mines, which, as you can tell, are desperately needed to meet these global initiatives and standards. So who are we and why is Tharisa relevant in this context? Well, we are mine builders. We take that difficult journey of discovery, of pioneering, exploring, and taking assets that are multi-generational through that whole value curve. And it is the most difficult journey to take when you look at the extractive industries, whereby you find a prospect, you explore, invest capital that you're not 100% certain will be viable, but you go through that value of exploration, you raise capital for development, and then you ultimately develop a sustainable business model that can see you through the cyclicality of the commodity cycles and the volatility that we see on a day-to-day basis. But this requires patience, it requires capital, and it requires a steadfast strategy and a commitment to that strategy. And one of the key aspects and attributes of Tharisa is that we've utilized technology, we've utilized innovation to extract value where others historically have either overlooked or disregarded the potential. And I think that is a key differentiator of the Tharisa business and the entities that comprise our business. So what do? We are a co-producer of platinum group metals and chrome concentrates. And what's key here are these commodities have real physical demand. So it's not some synthetic screen-traded derivative. It is a real primary demand, and we'll unpack those demand drivers in the latest slides. All the metals that we mine are designated as critical minerals with a very high economic importance. Platinum group metals have played a vital role in cleaning tailpipe emissions over many decades. And I always tell the stories, one vehicle's emission in 1960 is equivalent to 100 cars today. So we were polluting the environment without significant auto catalysts installed, and over time they've played a vital role in cleaning tailpipe emissions. And if we look beyond that, we look at the future of the hydrogen economy, fuel cells, and there is huge potential to continue to provide these vital catalytic properties that they are renowned for. Chrome is unique in its nature, and it is what makes stainless steel stainless. It is irreplaceable. Both PGMs and chrome are 95% recyclable. So when we look at the current environment that mining companies, particularly operating in South Africa, face, you'll see that the headwinds are fairly significant and are really not a stimulus for investment when you consider the electricity constraints that we have experienced in South Africa, albeit that they've stabilized partially, but there's uncertainty around electricity supply through Eskom. And we look at our transport infrastructure that has degraded and has really is operating at suboptimal levels. Then we couple that with the geopolitical complexities, inflation, interest rate environments, which all lead to volatility. And volatility in terms of commodity pricing, but also in terms of investment. And we see that in terms of what these various governments and policy makers are signaling to the various economies globally. And we are ultimately impacted by the major economies of the world that are the primary consumers of the metals that we mine. There's no doubt that crime and corruption impact the operating environment in South Africa. There's now obviously some positivity with the government of national unity with tackling some of these major issues around infrastructure as well as crime and corruption. So there is hope, which perhaps a year ago was lacking. When we look at climate change, certainly climate patterns have changed. When you run an open pit mine, weather patterns do impact productivity, do impact logistics. We've seen, weather fronts that come in and derail port infrastructure, rail, and so forth. And then there's the regulatory uncertainty in terms of fiscal provisions and regulatory provisions, which are challenging in any jurisdiction whereby you have long cycle investment horizons. And then capital availability, because of all of these headwinds, becomes limited and difficult to fund new mining projects. But it's not all doom and gloom. So when we look at what supports our business and really what gives us the confidence to continue doing what we do and have done, is that we have a resilient business model. By having a co-product business that produces chrome and PGMs, they're almost counter-cyclical by nature, and we've charted this historically, where the one performs well, the other perhaps has subdued pricing, and that is the case at the moment, where we see chrome demand and chrome prices being very buoyant and robust, and PGM prices being suppressed, and really on a gloomy outlook in terms of growth around auto sector, EV penetration, and we'll debate all of that, and ultimately the hybrid drivetrain playing a more vital role going into the future. But importantly, when we look through the cycle, we see fundamental demand for both commodities. And this is key to long-term investment decisions. Then on the macro front, I touched on hybrid drivetrains. There's a realization that the world's parking lot is not going to become electrified. There are two limitations. There are too many limitations. There are too many constraints. So there will be a multitude of choices and drivetrains that will provide solutions that are relevant contextually to the environment that they're required. And this is where I think the best of both worlds, the hybrid drivetrain, is starting to gain momentum. And we're seeing a lot of the European and North American automakers rolling back their EV expansion plans, which were, going at a furious pace and commitment of billions of dollars into giga plants and factories. And a lot of those have been suspended and rolled back. And we're starting to see commitment to the hybrid drivetrain, which is very important and supports platinum group metals demand for longer. When you look at the Chinese stainless steel market, the outlook is very positive, and we'll unpack that growth rate. Supply is really the story here. We know how difficult it is to extract these metals. We know the challenges that our peers are facing. And so with that overlay, supply constraints are going to be what is going to drive the deficits and potentially put markets into balance or into a physical deficit situation, which is where the chrome market currently sits at the moment. Then we've noticed a lot of capital investments in expansion and projects have been delayed, deferred, or cancelled completely. So this supports that supply side constraint theory. And then obviously being a South African rand-based business, our costs are in rands, so we're weaker rand to the dollar offsets a lot of the inflationary pressures because we sell in US dollars. So all in all, this has really proven that our business is resilient, robust, and can withstand the volatility. And something that we were a bit hesitant to celebrate was our 10-year anniversary of being listed on the JSE. But upon reflection, it was really a useful exercise to chart and reflect on the journey that we've taken and where we've come from. And we're very proud of the achievement of creating a sustainable business that employs close to 5,000 people, including contractors, and impacting almost 50,000 lives on a daily basis. And this is really the impact of investing in long multi-generational businesses like mining. We recently released our Q3 production statistics, so getting down to the nuts and bolts. A key value of ours is health and safety. And so it goes without saying that we focus on a zero harm environment. We have improved our safety statistics dramatically, and we're very pleased. However, we haven't achieved the zero mark just yet, and it's a constant embedded culture that is driven in every activity. To that end, we've achieved a 0.03 lost time injury frequency rate at the Tharisa mine, at Keyter Platinum, which is an active development site, and we'll show you some footage there, 0.1 lost time injury frequency rate per 200,000 man hours worked. So if we compare it to the industry, exceptionally good, but in terms of our own standards, still not where we want to be. We initiated a $5 million share buyback, which has been very well received and has proven to be very successful. So again, looking at ways to return value to shareholders by supporting our own investment case, and certainly the best return on our dollar is investing in ourselves. And you can ask every one of our employees, and they will share that sentiment. And then we look at our Redox One, which is a very new, exciting battery storage technology, which is well on track to commercialization, and we'll touch on that in the later slides. So when we look at our production statistics, we mined just short of 1.4 million tons, a nice improvement from the prior period, producing just short of 37,000 ounces of PGMs and producing 410.7 thousand tons of chrome concentrate. We averaged an exchange rate of 18.6. The PGM price slightly up, $50 an ounce, which is positive from the prior quarter at $1,391 per ounce. and that's for our basket. We have the 6 elements, which we'll share with you in the following slides. And then chrome prices being very strong and robust at $309 per ton, up from $286 per ton. Cash on hand, just under $190 million. Debt reducing nicely quarter on quarter to $97.7 million. So improving our cash position by some $20 million. And we're in a positive net cash position of $92.2 million, which is a great position to be in when you are developing and growing your business. In terms of our production guidance, we have remained consistent and steady with our forecast, which is to produce between 145 and 155,000 ounces of PGMs and between 1.7 and 1.8 million tons of chrome concentrate for the financial year. Just to remind everyone, our financial year end is September. So when we talk about being committed to our strategy and our vision, really our purpose is enshrined in our statement here, which is enriching lives through innovating the resources company of the future. We spent a long time developing this ethos statement, and really it's built on the foundation of these 6 pillars. First of all, we look at expanding our business through rolling out new initiatives and ensuring the sustainability of the existing businesses. We look at optimization through technology and through innovation, and we consistently invest in these novel and unique ways, a lot of them patented and proprietary to ourselves, which are value additives. You spend a huge amount of cost, money, energy, effort, and time to extract 1 cube of rock. And so our philosophy is you should take as much opportunity to extract economic value out of that rock as possible. And then when we look at diversification, we look at ourselves becoming globally diversified, and we'll look at the map on the next slide, which really points to that diversification, and then ultimately looking to become the investment of choice in this sector. All of this leading to responsibly enriching lives for all our stakeholders. So if we look at this map now, you can see that we've grown from a single mine in the southwestern limb of the Bushveld complex to a globally diversified business. And ultimately, we are providing security of raw material supply. We've seen the critical need for the security of supply, and this is achieved through the multi-generational mineral assets that we have in South Africa at the Tharisa mine and in Zimbabwe on the Great Dyke at Karo Platinum. And again, unlocking value through technology and innovation, and really fulfilling our strategy of being a pit to port miner. So we're not just selling our products at the mine gate, we are engaging with end users. So when you look at it, we have our R&D facility in Germany for Redox 1 in Dortmund. We have our various facilities in and around the Mooinooi area, Marikana area, and then our export channels out of Maputo, Richards Bay, and Durban for our commodities. When you look at the resources that we have, they are significant. And at the Tharisa mine, when you look at PGMs, we have 39.4 million ounces of PGMs. At Karo, our phase 1 only, and this is the open pit phase, is 11.3 million ounces. Historically, there's over 90 million ounces declared over the tenements that we have in Zimbabwe. So a massive resource, and we're really just scratching the surface. In terms of chrome metal, we have 166.2 million tons contained metal, that's 100% chrome, in the Tharisa mine resource. So just touching now on those resources and the commodities. Today's chrome price is at a relatively high level. Importantly, coupled with a weak South African exchange rate, is most probably at record rand levels at sort of circa $320 per ton. We mentioned that there's no substitution for chrome in the production of stainless steel. I think what isn't commonly known is that South Africa hosts over 70% of the world's chrome resources, and the biggest consumer in the world being China and Greater Asia has no chrome resources of their own. So they're wholly dependent on the import of chrome units from around the world. And to that end, South Africa supplies 80% of China's requirements for chrome. This mine of ours, Tharisa, accounts for around 10% of China and Indonesia's chrome demand. Why Indonesia is there? Because there's a mega stainless steel complex, which is owned by Tsingshan, the largest Chinese stainless steel producer in the world. And they are one of our big customers. When we look at the chrome price and we overlay the port stocks, the inventories, you can imagine now if you are wholly dependent on the import of a raw material, you need to keep critical supplies in your port to manage the pipeline inventories into this huge metallurgical complex of ferrochrome and stainless steel production. So when you look at the historical port stocks and you look at today's port stocks, you'll see that they're sitting at, I don't want to say critically low levels, but low levels bordering on critical. Because if there is a supply disruption, if there is a challenge in terms of delivery of cargoes into China, there will be a deficit in physical terms. So we see that the port inventories that are currently sitting in China at the moment are just below 6 weeks worth of supply into the demand that we currently see in China. And that demand has been predictable and has been consistent over many decades at around 5% compounded annual growth rate. And when we look forward in global terms, we see that rate growing at 3.5%. So what does that mean for chrome demand? That means that an additional 1 million tons of chrome concentrate is required on an annual basis to meet this fairly muted growth rate. So there's no stimulus here. There's no additional false demand in the system, particularly in China. There are new demand drivers and new applications for stainless steel, which has driven this growth rate, which whether it be in construction with the use of stainless steel rebar, or whether in conversion to heat pumps, which has been legislated in many European companies, which are big demand drivers and end users of stainless steel. And then we look at the Indian economy, which has the lowest per capita consumption of stainless steel, which is now mandating its own industry to grow stainless steel. And in fact, we are now delivering cargoes to India, where they are looking to compete with the Chinese stainless steel growth. So outlook in terms of chrome demand, very strong and robust. Now, there's a lot of research and a lot of discussion around platinum group metals and electric vehicle penetration. What we can say unequivocally, automotive sales are up year on year, 92 million vehicles. The penetration rate of battery electric vehicles has disappointed all analysts and all assumptions. What this means is a slower uptake, and as I mentioned in my introductory slides, is the major automakers outside of China are starting to roll back and starting to consider their strategy of all electric vehicles by 2035. And the CEO of Lamborghini, in fact, came out today on Bloomberg saying that for as long as he's allowed to, he'll continue producing hybrid internal combustion engine vehicles, and legislation will be the only reason why he would stop doing it, because it makes sense on all levels when they consider the consumers, particularly the residual value of vehicles. And we've seen, many accounts of electric vehicles losing 50% within the first year of ownership in terms of value. So there are many challenges. We believe that technology and efficiency will solve many of the technical issues, but ultimately the hybrid drivetrain is the solution for the short term and medium term, and we're seeing a lot of investment going into that. When we look at the critical nature of platinum group metals and the role that they play, they're very unique and very special metals in terms of their catalytic properties. And this has been identified for the hydrogen economy. So we start seeing, in terms of electrolysis, converting water to hydrogen and oxygen, the critical need for platinum, iridium, and ruthenium. Now, iridium and ruthenium are the minor metals and can only be extracted as a byproduct of the major platinum and palladium rhodium and gold metals. So there is a catch here that PGM mining needs to continue to fulfill platinum demand into the future, and also the hydrogen economy demand for the PEM electrolyzers. But what we're also seeing is more stringent emission standards being introduced in the US Tier 4 and the new Euro 7C, I believe it is, coming into play. And these require more loadings or more metals in the autocatalyst, which provide cleaner tailpipe emissions. So when we look at it, without a prejudiced view and a balanced view, yes, the story of EV penetration was a threat and is a threat to internal combustion engines. I think reality has set in, and the view that the world will be electrified has changed, and the multi-drivetrain solution is now what most people are buying into, and certainly big investment going into new hybrid electric drivetrains. Even in China, BYD, the largest electric vehicle maker, has got 4 hybrid products that they've just recently released. So there has been this realization. When we look at pricing of PGMs in the bottom right-hand chart, you can see we've come down in the last 3 quarters from relatively high basket prices, really, I believe, on the back of uncertainty of demand and particularly the supply side constraints materializing. So coming to the Tharisa mine and what we see as unlocking strategic value and flexibility. This is really our flagship operation. This is the cash generative part of our business, and it is a mechanized, highly skilled labor force mine that has been operating for 15 years now. We have very unique, integrated but independent plants, the Genesis and Voyager, that produce both PGMs and chrome concentrate, and then our new proprietary and patented ultrafine Vulcan chrome plant, which captures those fine particles that traditional metallurgical processes cannot recover. We've also accelerated the studies and the strategic drive to go underground on the west side of our open pit mine. We have 3 open pits, and this really unlocks 60 years worth of life of mine by going through a decline shaft complex and on-reef development. So quite excited at having a sort of hybrid mine of being open pit and underground as we develop the mine into the next generation. We also committed to reducing our carbon footprint by 2030 by 30%, and we're well on track to meeting that target. You may know that we announced a dedicated 40 megawatt solar plant, which is under regulatory approval and contract award as we speak, which will be built adjacent to the Tharisa mine. But just as of today, we announced that we signed a wheeling agreement for green wind and solar energy, which accounts for about 44% of our energy requirements today through Etana, which is one of the independent energy traders, licensed energy traders that are busy building a wind and solar project in the Western Cape and Northern Cape. So really committed to that decarbonisation strategy. There are other benefits, cost of energy and security, which as we know, are critical in the operating environment. Then when we move further north to the Great Dyke, the second largest geological formation on Earth for platinum group metals, it is really a world-class project, huge resource, over 25,000 hectares. We really are touching the surface with our phase 1 10-year open pit life. Our construction continues. You will know that we've slowed down the development in light of the current economic outlook for PGMs. And what we've done in parallel to that is we've looked at innovative ways to value engineer the project, to look at other revenue streams from the business, and that is progressing very well. What's key here is the capital that's been allocated is aligned to those work packages. So we're not overcommitting beyond the capital available. The balance or gap funding is well underway. We have term sheets signed. We are busy with the final due diligence, and we hopefully will have that resolved by the end of this calendar year. I will now share a short video of the production site at Keyter. So as you can see, all the sort of earthworks and civils are well underway. The long lead items have been ordered and mostly delivered. So we are ready to accelerate the project on the back of that funding commitment, and believe that we will, in the next 24 months, be able to deliver our first answers from the Keyter project, which hopefully will be aligned to a recovery in the PGM pricing market. So we spoke a lot about innovation throughout the presentation, and really it's more than talk. We have a culture and ethos of innovation, and Arco Metals, our wholly owned subsidiary, is really the entity that's driven this innovation. And we have world-leading experts in various fields, be it stainless steel, PGM, refining and production, and or battery technology, that are working for us and really looking at driving these initiatives to commercialization. Ultimately, we're not an R&D house, we're a business that looks to unlock value and commercialize as fast as possible. So for a business our size, I think we punch well above our weight in terms of the initiatives that we undertake, the challenges that we look to solve. At the Arco Metals beneficiation site, it's a pyrometallurgical smelting complex where we produce novel and unique alloys of both chrome and PGMs. And we also have a proven refining process for PGMs, which is at a much lower cost than conventional refining. And we are busy commercializing the whole end-to-end production of our platinum group metals. Traditionally, junior miners and new entrants into the platinum group metal space were required and needed to sign concentrate agreements with the major PGM miners to refine their metal. So we, as with most of our peers, have been selling our concentrate to Sibanye and Northam recently, historically to Impala, and we get a percentage of the payable metals. The intention here over the next 24 months is to refine our own metal and have the metal in our hands to sell and trade and market independently. And it will be quite unique and novel for us to be an independent, smaller scale refiner of PGMs. Our development center is in collaboration with the university, and we run lab and pilot scale test work with a focus on downstream beneficiation. Our renewable energy center is adjacent to the mine, and here we focus on energy generation, storage solution, utilizing our commodities that we mine, and we are trialing and testing and demonstrating, in fact, these different technologies. And this is where our very exciting business Redox One was born and being developed alongside our colleagues in Germany. And we recently launched this business at the Africa Energy Indaba in March 2024. So why are we looking at long energy duration storage? Because there is a desperate need to store renewable energy for long durations. We're not talking about lithium-ion batteries here or mobility to go into a cell phone or into a car. These are large industrial scale, megawatt to gigawatt scale installations, and there is a global shortage of cost-effective, long duration, long life technologies and solutions. And this is where redox flow, a very old technology, can provide the solution. And because we mine the iron and the chrome from first principles, we have a unique advantage because we have a fully integrated pipeline from the pit to the storage system. We can be hugely competitive in our costs, and there's IP and technology that we have developed and patented that differentiates us from existing and proposed technologies. I'll share a short video now with you on Redox One.
Africa, a continent of unparalleled beauty and limitless potential. With vast reserves of chromium and other valuable materials, Africa holds the key to the world's energy future. It's not just about minerals. Africa boasts abundant sources of renewable energy, sunshine and wind from coast to coast. Enter Redox One, a pioneering company dedicated to harnessing Africa's wealth of energy resources. With proven cutting-edge technology and innovative solutions, Redox One can harness renewable energy, making it available 24/7. From mine to megawatt, Redox One owns the entire process, ensuring safe and reliable long-term energy storage. Together, we can unlock Africa's full potential and power a brighter, greener future for generations to come. Redox One, empowering Africa's energy future.
So our strategy of going from mine to megawatt is in effect being rolled out. We are commercializing these units and scaling them up. We have demonstration scale units in South Africa and in Germany, operating on our own manufactured electrolyte, which is the iron and chromium. And we are looking to scale up into the new calendar year to megawatt scale, and then from there on to roll out test sites in the Middle East, Europe, South Africa, and North America, and ultimately providing a cost-effective, long duration, long life, 30-year life solution, which is environmentally friendly and 100% recyclable. And this is where the circular economy really comes to play, where you can utilize the metals that you mine to provide a solution that the world desperately needs in a cost-effective and sustainable manner. And we can see that with the platinum group metals as well, where we look at the hydrogen economy and the value that hydrogen can play as a green source of energy for either storage and or electricity generation, or through fuel cells for mobility. We're seeing big uptake in the aeronautical industry, as well as the shipping industry, in various derivatives of hydrogen and ammonia, the most probably the preferred carrier to date. And then when we look at stainless steel, it touches every part of the economy. It's utilized from basic industrial applications to space and beyond. If you look at Elon Musk's rockets made out of stainless steel, because they're a fraction of the cost of carbon fiber, but they provide the properties that are corrosive resistance and ultimately recyclable. So we are well positioned to capture the value of the circular economy and ultimately provide a mine to megawatt solution that we believe has massive potential going into the near term and longer term. So coming back to the rands and cents or dollars and cents, we are focused on capital discipline. And one of the key drivers is return to shareholders and value to shareholders. We recently announced our interim dividend of 1.5 US cents, aligned with our dividend policy, which has been in place since 2016, of 15% of net profit after tax to be distributed to shareholders in the form of a dividend. But when you couple the $5 million share repurchase program, which is value accretive on an EPS basis, this is equivalent to another 1.7 US cents per share. So all in all, if we couple the two together, you're looking at a 24.5% potential return to shareholders of NPAT at the half-year mark. One thing for certain is our dividend policy is sacrosanct, and we haven't deviated from it throughout the various challenges that the industry has faced. And certainly we envisage us continuing into the future on that similar basis. When you add up the cumulative distributions to shareholders over the last 9 years, we've distributed just over $100 million to our shareholders. So what is our investment case? We are mining critical commodities and metals that are required and needed for the future of all economies and industries that we've mentioned in our presentation. Our own output is set to double with Karo coming online, so we will double our PGM production. And importantly, which we didn't touch on, we will be producing a large amount of byproduct base metals, and that's copper and nickel and even cobalt from the Karo project. And it's one of the unique features of the Great Dyke of Zimbabwe. You get those credits of base metals. In everything we do, we look at operational flexibility with mechanized operations, with multi-pit, multi-processing facilities, looking at shallow, easily accessible tabular ore bodies, and looking to replicate that, and in fact doing that at Karo as we speak. Capital discipline is key to any capital-intensive business like our own, and I think we've succeeded in providing enough capital to sustain our businesses, to expand it, to grow, and also to return value to shareholders. And we've also unlocked value through our integrated marketing and logistics businesses, which we don't talk about often, but really differentiates us from mid-tier producers where we handle our own material. And it gives us a key advantage when you consider some of the constraints with Transnet and logistics, where we've been able to deliver consistently through all the challenges that we've experienced as a country over the last few years. And then our strategy of diversification through beneficiation, innovation, and technologies is well set and is bearing fruit through the various initiatives that we've touched on. So with that, I'd like to thank you all for your time and end on this slide, which really captures the essence of Tharisa today. We see ourselves as an end-to-end critical metals and energy solution provider, thereby innovating the resources company of the future. When you look at it over the last 15 years, we have been successfully operating. We've been cash generative for 10 years. We've been profitable for 9 years. As mentioned, we've distributed over $100 million to shareholders, and we've invested just short of $700 million. So committed to raw materials, innovation, beneficiation, and strategic multi-generational extraction of these critical metals. So with that, I'd like to hand over to the finance ghost of Mark for Q&A. Thanks.
Thank you so much for that. That was a great session, and yeah, straight into the questions. Over to you guys.
Yeah, thank you so much. It really was an excellent presentation. Thank you to everyone attending the call. So we've got about 15 minutes for questions, which I think will be a very interesting session. I'm going to kick off with the big one, which is around EVs, because I think it's something that we do need to cover in as much detail as we can, really. EV adoption, look, I'm a dyed-in-the-wool petrol head, so I would love to see the internal combustion cars last forever, but I did recently travel to Europe and I was quite interested at the level of EV adoption. And obviously I've been following the automakers, the hybrids, the pullback on EVs. I mean, it seems like there's definitely been a disappointment in the level of EV demand. I guess it's very hard to know long-term where this all ends, but from your perspective, you know, a hybrid vehicle versus an ICE vehicle a few years back, does the hybrid vehicle use, you know, more PGMs, less PGMs potentially than a traditional ICE vehicle? So is there any difference there? So if every car was a hybrid as opposed to an internal combustion engine, you know, does that affect the PGM market at all? And then do you have any views on, you know, levels of EV adoption that do hurt you? So if every second car on the road was an EV, you know, is PGM mining still something you can do? It's obviously really difficult. It's an impossible question to know for sure, but just anything you can share, thoughts around adoption and what that means for you long term.
Yeah, certainly. So just to tackle the various questions, in fact, hybrids utilize more platinum group metal loadings than your conventional internal combustion engines, primarily because they're not running all the time. So the cold start is always the biggest emitter of emissions. And so what we found with the smaller engines that are coupled with the electric drivetrain, their loadings are more per capacity or engine size. Where it's changed now and evolved is where we've got a electric vehicle that has an engine which is actually a generator. So it is charging the battery. The petrol or diesel engine is charging the battery. And this is now the next generation. And if you've ever been to London and you see the EV black cabs, those are actually hybrid vehicles. And they've been running those for 7 odd years now. And it gives the EV tick and badge because it is an electric drivetrain, but it's supported by in that case, a petrol engine, which will have higher loadings than a traditional internal combustion engine. So when you look at vehicle sales are actually growing, and it could be a function of pent-up demand. In 2023, we saw 92 million vehicles being sold, not all internal combustions, and the penetration rates of EVs took a big chunk of that, circa, let's say, 10% of that market, which historically was internal combustion engines. The biggest adopter of EVs is China. And if you go to the major cities, Shanghai and so forth, you'll see the prevalence of electric vehicles. Why are they able to do it? One, it's a policy-driven decision, highly subsidized by government, and also, infrastructure has been upgraded to cope with charging. Whereas what we've seen in the other jurisdictions around the world, the big auto consumers, North America and Europe, is that adoption has been poor for a number of reasons and slower. One, because of the residual value. And don't underestimate this, that within a year you're losing 50% value of a Tesla. The cost of insurance is considerably higher because of the combustion risk. Your household, if you've got an indoor garage, your vehicles parked inside homes have been burnt down because, to put out a lithium ion fire is a challenge. So you need fire blankets and things. So it has evolved. I mean, people have identified that, but if you're not prepared for it, and then the degradation of the batteries has become a big issue. Now, all of those can be solved with technology, and what the realization from the rest of the world's automakers is they just cannot compete with China. And we've seen a 4-fold tariff increase in the US, and if I'm not mistaken, 25% increase in Europe on Chinese electric vehicle imports. And this is really trying to protect the European and North American automakers against a highly subsidized Chinese EV market. And the place that the Western, let's call them, automakers have seen where they can compete and still meet their sort of global commitment to EVs or to emission reduction is through hybrids. And this, if you look at Toyota were seen as dinosaurs because they were the only ones that were not committing at all to convert to EVs. They weren't coming out with these statements by 2030, everything's going to be EV. They were the ones that said it's not going to work, and we're committing to hybrids and to internal combustions. And they have actually proven to be correct, because if you remember, the Prius was the first hybrid vehicle that we saw, at commercial scale. And so they were ahead of their time there, but seem to be lagging the rest of the industry. Now, when you look at PGMs, to your question, what happens if half the world turns in EV, pure EV, and the rest is hybrid or internal combustion? It will have a big impact on demand of PGMs, in particular palladium and platinum. Rhodium. Those are the 3 major components. This is where the hydrogen economy is seen to pick up a lot of that slack of demand, as we see the deployment of an investment in hydrogen facilities, green steels, which utilize hydrogen. We've seen that Finnish steel, green steel company, €6 billion business that has been launched, subsidized by grant funding, but there's real capital going behind hydrogen. Yes, there have been false starts, there's been over-optimistic assumptions, but not dissimilar to EVs. So our view is that it's going to be a hybrid or a multitude of various drivetrains, and in certain jurisdictions, EV cars will just not work. Consider Africa, consider the Congo, you know, where mines are running on generators or solar plants. You know, physically the infrastructure is not there to electrify, let alone basic industry, but to charge vehicles. And then if you know, just statistically, you've heard the analysis, you'd need another 200 copper mines, you'd need to triple the world's grid to electrify the world's parking lot. So there are real physical constraints to it. And so I think their sanity has prevailed, and the lobbying and the politicking that was behind this whole green agenda has become more balanced. And so you've had politicians, you know, decreeing and announcing policies, which has driven a lot of investment in the Western world, which, as we've discussed, has been rolled back now to more sort of sensible outlooks. I hope that answers a broad range of questions there.
Yeah, for sure. Over to you, Mark.
Yeah, just a quick one from me, maybe just operating environment in South Africa, when we've seen, you know, load shedding has been a thing of the past for the last few months, but we do see announcements about load reduction, which you know, impacts, you know, large users, mines, and the like. And also we've had a few companies mentioning their sends, and we've had them on here, that you know, things are coming off a very low base but improving at Transnet. So maybe just talk about, you know, load shedding, the impact of the wheeling agreement coming in now, and what that means overall with the solar plant combined, and if you're kind of seeing any green shoots or improvements at Transnet, or even maybe a change in attitude when you do talk to management with the complaints that you have.
Yeah, sure. So just in terms of large-scale industrial users, we fall under load curtailment, and this is a bilateral agreement with Eskom. So they would call us and say, we need 10% reduction, 20% reduction. And you may recall we installed 10 megawatts of standby diesel generators just pre-COVID. And what we've done historically is turn on those generators and feed that power into the grid to assist other industrial users that are critical, you know, whether it's underground miners or smelters that can't curtail energy. We haven't had any calls for load curtailment in this recent period, as you mentioned, but we are geared up to navigate even up to level 6 equivalent load shedding. So I think we've covered that base historically. Going forward, as you rightfully say, we have these renewable energy projects, the wheeling agreement, which utilizes the Eskom infrastructure. So we're still dependent on transmission from Eskom, but we do get the green credits, and then I would say a preferential tariff. The energy comes in lower than our current price with Eskom. So there are those benefits. When we have our dedicated solar, that's behind the meter, so that's dedicated power and does not require Eskom infrastructure. So that gives us a degree of independence. But remember, it's limited to daylight hours. So that's where a long energy duration storage solution like Redox One could come into play, because if you could store that energy over 12 hours, then you become completely independent, as I say, off the grid, which is the vision. We're not there yet to store that scale of electricity, but it is a potential, and certainly one of the first test sites of megawatt scale will be the Tharisa Solar Project. So I think with Eskom stabilizing and we're seeing some positivity around decisions and management there, I think the relationship has always been good on an operational level, and we've been supportive and understanding of their constraints. We are driving our own independent initiative, as mentioned. With Transnet, it's a funny thing because industries adapt. We used to move 85% of our cargoes by rail. We now move 85% by road and only 15% by rail. And we know what that means for traffic. We know what that means for congestion at border posts, at ports, et cetera, et cetera. So the ideal would be to revert back to more rail than road. We are seeing green shoots. We are seeing an attitude shift, and we do believe that the public-private partnership is the way to go. In fact, the only way to go, where there is a partnership to solve some of the backlog issues. Security and theft have been major limitations and constraints. Maintenance of infrastructure, rolling stock availability, you name it, compounding issues. But we are starting to see those green shoots, and we believe that it will come off a low base, but we'll start seeing improvements in the medium term. Not a quick overnight fix.
And just the cost impact, because we had, I'm trying to remember one of the, I think it was TWK, and they're doing not the iron ore, but wood chips up and down from Mpumalanga, and the difference between road versus rail on a cost per ton basis, was practically double for them. Just if you've got a rough number there of rail versus road, cost per ton impact, if you flip from 15 up to 25, will that have a noticeable impact on the cost line?
Yeah, it's not as significant as others. We estimate, because we are utilizing it, between 15 to 20% differential on the land side cost from mine to port. Bearing in mind the handling is a lot better in port. You don't have to have staging areas. The time, just there's a whole host of benefits beyond just that cost per ton. There's efficiencies in the system, or rand per ton. But yeah, 15 to 20% is our range.
Okay, perfect. Thank you.
Sure.
I just want to touch on the chrome side while we have a little bit of time, because that's the side of the business that I think gets less attention than the PGMs. I think you tend to get lumped in with the rest of the PGM players to a large extent. So
Yeah.
Two questions. One is just because I don't know enough about chrome, and I know the European ferrochrome benchmark price that was cancelled earlier this year. I just wanted to understand if that has any effect on you whatsoever. And then the second one is I think a more structural question around China. And if I heard correctly in the preso, I think you said it's been about a 5% compound annual growth rate in stainless steel demand in China, and you said it's coming down to about 3.5%. What does that mean, do you think, for chrome prices going forward? Just that sounds like obviously a little bit less demand over time relative to how supply might be coming on stream. Obviously, China is a big focus at the moment in terms of growth there, or a little bit of lack thereof, not least of all in construction. So it's the ferrochrome benchmark price, and then just, I guess, some more learnings about China and chrome.
Yeah, so that benchmark price, I think, was a legacy pricing mechanism when South Africa were the dominant ferrochrome producers in the world, and that kind of set the level for European ferrochrome consumers and stainless steel. The stainless steel surcharge, there was a surcharge tariff, and it was negotiated on a quarterly basis. It lost its relevance many years ago when China overtook South Africa in terms of consumption and production of ferrochrome. So it had very little bearing other than just to correlate between the China terminal market and the European market. And if anything, the Chinese pricing dictated where that European benchmark ended up on a quarterly basis. So yeah, it has no impact on us. We are Eastern facing in terms of our market. It is a highly liquid market. It's traded on spot prices and is tracked by a number of sources. So it is transparent in that respect. You can pick up the pricing relatively easily. In terms of chrome demand, you have to remember that there's a massive installed base, close to 60 million tons of stainless steel production in China. So a 3.5% growth, which I believe is conservative and will be higher, means an additional 1 million tons of production that doesn't exist today has to come in the market to meet those chrome requirements. So when it comes to pricing, we've seen strong prices for a long period now. So those inventories that we spoke about in Chinese ports are at high prices, so they've been bought in. So historically, Chinese port inventories were used as a lever to keep prices down. So they were bought at low built up at low prices, and as soon as seaborne cargo was elevating, they would pull from port inventories. That luxury is gone because it's literally a just-in-time supply chain at the moment. And the other interesting factor are these new applications for stainless steel, taking over galvanized steel, which is a more expensive product. And a lot of these new stainless steels are a lower quality product, cheaper, but utilizing more chrome. And that is where the nexus between South Africa and China is so critical, and that security of supply is so fundamental. So our outlook is bullish. We believe prices will remain strong for longer because of these fundamentals. And for us, we get asked often, because we're one of the few public companies that speak about chrome, what is a long-term sustainable pricing? We believe anything above $250 a ton at an 18-to-1 exchange rate is a great price going forward. Today, as mentioned, we're at $320 a ton, so a significant premium to that long-term pricing. And we very well may see that edging up based on physical demand. So these new applications have created new green shoots of demand. We have a slide in the deck which we'll share with the audience, which talks about new applications of stainless steel, and we speak about stainless steel rebar, which has multitude of benefits over your typical carbon steel rebar. Its ductability, its pliability in infrastructural buildings, in bridges, in high corrosive environments at coastlines, and this has now become almost a standard for new large-scale industrial or construction complexes. So these are demand drivers that didn't exist a decade ago. So we believe in these green shoots. And then don't forget India, the largest population, lowest consumption per capita. And we speak to a number of the large Indian miners and stainless steel producers, and we're hearing of new investment going into stainless steel production there and becoming independent of China. So yeah, the outlook is positive from our perspective.
I'm going to squeeze one more
are
in
you
here
going
if I can,
to?
Vanessa. Quick, yeah, we'll go to 5 past, one more. Just
Okay.
quickly, just on capital allocation, because I know you touched on it in the slide, and I think it is important when we've got kind of retail investors on. The mix between the buyback and the dividend for returning capital to shareholders, is that something we should expect to see continue after this kind of buyback process is completed? Or will it, as the board's kind of thinking we're doing this buyback now, we're going to revert back to a standard dividend with that, I think, would you say 15% of NPAT policy? Maybe just kind of where the kind of thinking at a board level is on that capital allocation.
It's a great question. So as mentioned, the dividend policy is set in stone, and we won't deviate from that. I think we've all been pleasantly surprised at the success of the share buyback, because often it doesn't realize in share appreciation. I think from the time we announced it to where we are today, there's almost a 30-odd%, 35% increase in our share price. So it's provided that bottom end support for our share, provided support for liquidity, and we've seen volumes increase considerably, knowing that there's this underpin of a share buyback. It is very technical, and it's limited by ranges of 5% on a 5-day VWAP, quantum, and so forth. So it's not just a free-for-all buyback. It is governed by some fairly strict rules, and within that, it's done exceptionally well. So from a personal point of view, I would like to see us continuing with a buyback policy because of its, the success we've seen. From a board perspective, we haven't discussed it. I think we would see the conclusion of this $5 million buyback and then assess it and look at the impact on earnings per share, the sentiment from our investors and brokers, and then I think it would be looked at favorably to continue into the future.
Thank you so much to everyone who participated, and especially to Tharisa, Fevos, and Elia. Thank you so much. This was a great discussion. I'm sure we could have carried on with the questions, definitely. So if there are any more people on the call with questions, please pop them to ir@tharisa.com. We know we've run out of time, so they'll answer them for you. This session was recorded and will be on the Unlock the Stock YouTube channel next week. And then please don't forget, we've got another session coming up on Thursday, the 12th of September, and that will feature CANS. And that is all from my side. To everyone who participated, thank you so much and goodbye.
Thank you.